Okay, and welcome back, students who are taking financial accounting, and we're working on the assigned homework problems from the digital study guide for chapter 7, the short exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or contact an instructor. All right. So let's see here. We were on 15. All right. It says here, accounting for notes receivable. Pacific Bank lent $125,000 to Robert Simons for a 30-day 6% note. Record the following transactions for Pacific Bank. Explanations are not required. Okay, so he's lending the money on June 12th, and then he's collecting the principal and interest at maturity. Specify the date for the computation of interest. Use a 360-day year and round to the nearest dollar. All right, so number one, all right, he's lending the money on June 12th. So my entry is going to be for June 12th. And if I'm lending the money, well, what am I doing? Well, am I affecting cash? Yes, cash is, I'm decreasing because I'm lending the money. So I'm going to credit my cash for 125,000, and I'm going to debits have to equal credit, so I'm going to debit something else, and that's going to be a notes receivable to Simons for 125,000. So that's my initial journal entry when I lend out the money. Now it says here, collecting the principal and interest at maturity. Okay, so at maturity is when? All right, well, draw a timeline. Right, this is 6/12, and it's a 30-day note. So 30 days later, this time frame is 30 days. Right, so that puts, let's see, June has 30 days in it. So that's going to make the maturity date 7/12. Okay, notice I looked, I looked at the calendar and I said, how many days does June have? And it has 30 days. So 30 days later puts the collection at July 12th. But let's just say hypothetically that it had 31 days in it. Well, then the date would not be 7/12, it'd actually be 7/11. All right, because what you're doing is you're counting the number of days. You can't just assume every single month has 30 days in it. You have to look at the calendar to see which days have 31. Or in the case if this was February, where you were going across the month of February that only had 28 days, well then instead of 7/12, it'd actually be it would be March. Instead of March 10th, it would be March 12th, it would be March 10th, because I'm saying that this was on 2/12. Okay, so you have to pay attention to the number of days in the month in order to arrive at the correct date that has the maturity value. All right, but in this case here, June has 30 days, so 30 days from 6/12 is 7/12. All right, so we're going to collect the principal and interest at maturity. All right, so we're going to receive cash, so I'm going to debit my cash. And the question is, how much? Right? All right, well, we have to figure it out. For the computation of interest, use a 360-day year. So if I'm borrowing 125,000 at 6% times 0.06 for 30 days, and we're using 360-day ordinary interest, right? 360. We just had gotten done doing this in problem 7, 10, 11, 12. Actually, in 14 we did 4 of them. Okay, so if you need more help with doing this calculation, go back and watch problems, short exercise 7-14. We actually did 4 exercises, this exact same calculation. right? So if I take 125,000 times 0.06 times 30, I get 225,000, and that's divided by the 360 days, which gives me my interest of $625. Okay, so that's my interest. Now, if that's my interest that I'm going to collect, now remember, debits have to equal credits, so I'm going to credit my interest revenue account for $625. Now notice I didn't, what I'm going to do is I'm going to back into the amount that I should receive in cash, or in essence calculate it all out and figure out what my total cash should be. I know I'm going to debit my cash, and I know that I'm going to pay off, I'm going to calculate my interest, and I also know that I'm going to pay off my note receivable. So my note receivable, all right, is going to decrease, and that's for 125,000. Remember, the note receivable is an asset. We had debited, right? We had debited the note receivable for 125. So now, since now we're, it's being paid for, so we're clearing it off the books, so we have to credit it. We have to credit it, okay, for the 125. And of course, now that we've taken care of the note receivable and we recorded our interest revenue, the total of the two becomes the amount of cash that we're actually going to receive. So in this case here, it's $125,625. And that's what my journal entry would be for the, number 2, collecting the cash there. All right. Relatively simple. Let me clean this up just a little bit, and I'll briefly go over it again. All right, so number 1, we're going to lend the money. So cash is, we're going to decrease our cash by 125, and since we're creating a note receivable, we create a new account, and call it a note receivable for Simons. And so that's our entry when we lend the money. When it gets paid, all right, we know that we're going to decrease. Well, if I'm making a journal entry, I ask myself, am I affecting cash? Yes. So I would debit my cash because we're getting that money in. But I don't know how much that is because I don't know how much interest has been received. All right. I then have to go and calculate the amount of interest. And the note was for 125,000 at 6%, 125,000 at 6% for a 30-day period. And it tells us we're using the ordinary method of 360 days. Okay, so when we multiply that out, we end up with $625 in interest. Well, that's revenue to us, right? Because we only lent out 125,000, we're getting 625 additional dollars in interest. So I have to credit interest revenue for the 625. And of course, since we're receiving all of the money back for the note receivable, I'm going to credit my notes receivable for 125. So the amount of cash that we're going to receive is the total of these two, right? And that's why we debit our cash for $125,625. That should be the amount of the check that we received. Okay. All right. If you didn't understand that, go back and watch the videos that I suggested, the theory videos, or in the calculation of the interest problem, short exercise 7-14. And if you still don't get it, feel free to contact an instructor. All right, next problem here. It says here, calculate the quick assets and the quick ratio for the following companies. So remember, this the quick assets and the quick ratio is in the focus on decision, CION, making section of the chapter. Okay, so go back there and reread that. Definitely, if you don't know what a quick asset is or the quick ratio, definitely for the quick asset, go back and watch the theory video for this chapter, because I explain the difference between current assets and quick assets. Okay. In this case here, it says, let's see here. All right, for each of the following companies. So let's do roads first. We have our, for our quick assets, we have $15,000 in cash, and we have a short-term investment, which is $6,000, also called marketable securities. Right? This is they generally don't call them short-term investments; they call them marketable securities. And remember, these marketable securities are generally when one company buys the stock of another company. All right, they're making these investments hoping that the price of the stock goes up, and they then sell them off, and they basically they're playing the stock market, right? One business is playing the stock market on the other business, on other businesses. All right, so that's 6,000, and then our net receivables, which is also a quick asset of 41,000. Current liabilities obviously are not part of the asset section, so we end up with a total of our quick assets of 62,000. All right, and then of course we have to, for our quick ratio, we're taking our quick assets and we're dividing them by our current liabilities. So if I have 62,000 in quick assets and I'm dividing by 40,000 in current liabilities, that gives me a quick ratio of 1.55. So for roads, it's 1.55. Right? Right, pause the video because I'm going to erase this. And we're going to basically do the same exact thing for Peters. Right? So I'm going to take my 23,000, add in the 13,000, and add in the 51,000, and that gives me 87,000. So I have 87,000 in quick assets, and I'm dividing by the current liabilities of 108,750. And that gives me, let's see, 87 divided by 108,750, and that gives me a quick ratio of 0.8. So for Peters, it's 0.8 is my quick ratio. All right, last problem here. I'm going to cover this in this video. I'm not going to make another one. Let's see here. It says here, calculate the accounts receivable turnover for the following two companies. Again, the accounts receivable turnover is under the section Focus on Decision Making in the textbook. Okay. And you can see that formula in the textbook, but briefly, it is the net credit sales. So let me do this up here. We have our net credit sales, and that is divided by our average net accounts receivable. Okay, and again, now I'm not going to go into all of the theory here, because I covered that in the theory video for Chapter 7 on doing this calculation. So I'm not going to get into what all is involved and how, even though this here is a basic formula, notice that we have the word net here, which means depending upon the amount of data you're given, you may end up having to calculate what the net credit sales is. And also notice that, we have an accounts receivable, but we have a net accounts receivable, right? And depending upon the data we receive, we may have to calculate the net accounts receivable, but we also have an average of the net accounts receivable. So we're going to average a beginning and ending net accounts receivable. So, I mean, I know I'm not explaining that by writing it all out on this here slide. Go back to the theory videos that for the focus on decision making for this chapter, and you can see all of the quote-unquote detail that's involved here. All right, but for right now, all we need to know is that we have net credit sales and an average net accounts receivable, but our data is giving us, yes, it's giving us a net credit sales, but notice it is giving us a beginning and ending accounts receivable. All right, so we don't know, we have to actually calculate the average in order to get the average net accounts receivable. We can't just use those two numbers. So let's work on Simpson first here. So in the numerator, we're going to have 90,000, okay, but we have to calculate our average net accounts receivable, and our average is the 18,000 plus the 15,000, okay, and we divide all of that by 2. All right, so we have 90,000 in the numerator, and then we have 33,000 divided by 2, which puts 90,000 in the numerator, and then what's that, $16,500 in the denominator. And if we divide the 90,000 divided by 16,500, we end up with 5.45 as our accounts receivable turnover. Okay, 5.45. And of course, in the theory videos, it explains, it gives an example of what that 5.45 means. As a number in and of itself, you don't know if that's a good or bad number. All you know is, your inventory your accounts receivable turned over 5.45 times. But you need to use it as a comparison against something else. And that was all explained in the theory video. So I'm going to erase all of this. So pause the video if you have to. And I'm working now on Martinez. Okay, and it's going to be basically the same thing. I have 48,000, and then I'm going to divide it by my beginning inventory. My beginning accounts receivable, not 2,000, 21,000, plus 23,000. Yeah. 23,000, and we're dividing that all by 2 because it's an average. Okay, so I have 48,000 over 34,000 divided by 2. Okay, so I have 48,000 divided by 17,000, and if I take 48,000 divided by 17,000, and that gives me did I do that right? 21,000 plus 23 is 44, not 34. Okay, sorry. Right, 44, not 34, so that's by 22,000. Right, so 48,000 or 48 divided by 22 gives me 2.18. All right, so that's the turnover, 2.18, the accounts receivable turnover for Martinez. And again, that number as a standalone number doesn't mean anything, but if you're comparing one with the other, then obviously Simpson is doing better because they're collecting their accounts receivable a lot faster and twice as much as compared to Martinez. Okay, so Martinez is probably taking on too many customers that are giving them bad debt. All right, they're probably not doing credit checks on the companies. They're just extending the credit, and they're getting whacked because their accounts receivable sit there and sit there and sit there instead of actually collecting on it. All right, so that's it for the short exercise problems. And again, if you don't understand something, definitely go back and watch the theory videos. I tried to point out as much as possible, where it's applicable. And if you go back and watch the theory videos and you still don't understand how to do the problems, then feel free to contact an instructor. And I'll see you in the next set of videos for the exercises for Group B for the Chapter 7 problem, for Chapter 7. All right, see you then.